One of the most important things I look at is whether or not homeowners, those with mortgages, are paying off their loans or the stress is getting to them and they're moving into delinquency. Today, I'm going to show you the latest numbers and what it means for the Australian housing market. Westpac is out this week, and this follows CBA, which came out last week. Now, the Aussie banks, the big four banks, are great because they give us a lot of data and it's a live feed into the housing market. People don't go out and buy mortgages, they buy houses, but to buy those houses, they need mortgages. And when we look at trends within the banks and the data that comes out of the banks, we get a really good feed with where people are in terms of their repayments. One of the things I like to look at is delinquencies. And delinquencies are basically loans that haven't gone bad yet, but are behind. And there's two ways you can look at delinquencies. There's 30 days arrears, so loans that are haven't been paid on time by 30 days, or there's 90-day arrears. 90-day arrears is the more standard number that the industry looks at. I like to look at 30 days because 30 days give us a live feed into what happens in 90 days. And the trend for Westpac is here. Westpac, for those of you that don't know, is one of the big four banks that have a lot of exposure into residential mortgages. They're probably one of the more less diversified big four banks, predominantly east coast of Australia, and very much your retail bank. They do have obviously a lot of other divisions, but Westpac is a really good feed into what's happening into the mortgage market. And what we can see here in Australia in Westpac's book is that 30-day arrears, which is the dotted purple line, has been going up, but 30-day arrears are still at 1.7% of the loan book, and that's actually not bad. I mean, it's not good, but considering all the interest rate rises that we've had, that means that 98.3% of loans are being paid on time, and that's really, really good because the banks also put aside a percentage of their profits every year towards loans that could go bad. So the 30-day trajectory is looking pretty good. The 90-day trajectory is really, really good. And then just before I go on, the 90-day 0.95, that's under 1%. That's at or around where NAB and CBA are. So we're seeing a consistent trend amongst the Aussie banks. And then there's a really interesting number that Westpac put out, and they say loans that are more than 90 days behind, but have what's called a 6-month serviceability holdout period, and they're only at 0.74%. So Westpac is trying to tell us here that even a chunk of loans that may be slow to being repaid or are in 90-day arrears, there's enough of a buffer, of an equity buffer there, where if the bank needed to move in, they would have excess capacity there over the loan, so the losses for the bank will be minimized. What's interesting about Westpac is not necessarily the mortgage book, which is in line with CBA, but what's happening in auto and car loans. And as you can see, auto and car loans continue to tick up. Auto loans for Westpac, about 3% of them are now in 90-day plus delinquencies. And this goes to show the point that I've been making over the past few months, in that as interest rates have risen, the mortgage is the first thing to be paid off because there's very limited options for people in a low supply market. The reason why house prices haven't come down is because if you sell, you have to go into the rental market, and the rental market in a lot of cases is a lot worse than paying a higher mortgage. So the number of alternatives for homeowners aren't necessarily there. Auto, different category. Personal loans, credit cards, different category. Personal loans and credit cards obviously do impact, your credit rating, and so there's a lot of sensitivity there around not paying those. But auto loans is really a guide into where the consumer is and where they're willing to let go and get a little bit sloppy. And auto loans have gone from about 1.5% delinquency rate 2 years ago to double that rate. So there's a little bit of heat in the auto market. No doubt car prices are coming down. And no doubt the cost of servicing those cars has gone up by a lot. They're on higher interest rates, and it's a sign there that there's stress. But the house is being paid down first, and delinquencies in the mortgage book are actually quite strong. What I'm going to show you next is where wages are tracking in Australia. That's important because it gives us a picture into inflation. Inflation is important for the RBA, and we're going to finish off on where we think the RBA is going to go based on one of its international peers. But for now, let's go and have a look at where wages data has come out this week. Wage growth is really important to look at, not just because we all want more money, but because that's where the RBA has been most concerned. The RBA has always had this fear that as goods inflation softens, service inflation is going to be sticky, and service inflation pressures wages, and then we enter into what's called the wage price spiral. So things get more expensive, people want to be paid more money. Because they're getting paid more, they push the price of goods and services up, and we're in a spiral. And they've wanted to break it, and they pointed to the labor market being quite strong, and that being a risk that wages are just going to keep rising too hard. So when I talk about wages not rising as hard as good news, it's not to say we don't want more money, but it's good news for the purpose of inflation and the purpose of the Reserve Bank setting rates. Wage price growth came out and it's measured quarter on quarter for Australia. And as you can see, the blue line shows how much wages have been growing. Now, yes, wages have been growing less than inflation, but that lag is what the RBA has been watching. The latest data came out and it shows that quarter on quarter, wages actually grew by 0.9%. So first of all, that shows that if you annualize that, if you multiply that by 4, we're going down from 4.2 to about a rate of about 3.6%. So we're coming back. That wage growth has probably spiked and is starting to come off those levels. The consensus, or where the market was around that number or slightly higher. And previously we had been at 1.3%. So that's really important. And that's something that I believe the RBA is going to be looking at. One quarter doesn't set a trend, but it's a sign that the jobs market is softening. We've spoken about that. Retail is on its knees. We've spoken about that. Inflation has moderated. We've spoken about that. And then when you add this fourth component, the fact that wages, the growth in wages has somewhat plateaued, and we're not necessarily going into a wage price spiral, I think that's good news. And what I want to touch on next and finally is what's happening in Canada, because that's a very good market for us to look at. That probably gives us a clue as to where inflation is going here in Australia over the next 3 or 4 months. As I've said previously, Canada is ahead of us, and it's a really good guide. And I think what the Canadian market is showing is something that will translate here in Australia. So let's go and have a look. So inflation in Canada came out this week, and the inflation data in Canada was actually softer than expected. Inflation actually came down by 0.3% for the month of December, and in January we saw flat inflation. So what's happening in Canada is that prices are starting to come down, and as you can see, in January the market was expecting inflation to bounce back up. Things came down in December. The market was of the view that we'll have a bump back in January, and we didn't get that. Inflation basically non-existent in Canada for the month of January. And if you have a look at the chart, you can see what this means. It was only less than a year ago when inflation was peaking at 0.5%, 0.7% per month. And since then, there's been somewhat of a moderation. But now, ever since September, where it dipped in October slightly higher, November, December down, January non-existent, we've now got a trend in Canada of inflation being contained. And the reason for this is because, much like the RBA, the Bank of Canada has moved aggressively. The Bank of Canada has put rates up and put rates up more last year, and is holding firm and has said that it's not going to move like the RBA until it sees rates coming down. They haven't been like the RBA this month coming out and saying that, we're going to put rates up. I still think that was a big bluff by the RBA. And I still think around March, April, we're going to be seeing a very similar trend in inflation here in Australia. What does that all mean? It continues to reaffirm my view that, one, interest rates are due to be cut towards the end of the year, regardless of what the RBA says, regardless of what their policy statement said this week. I'm looking at the data, and the data is showing me that inflation is coming down, that unemployment's rising, and that people continue to pay off their mortgages as a number one priority. And that's going to impact services, that's going to impact retail, and that's going to limit the amount of wage inflation that we get here in Australia. Number two, the Aussie property market is still strong because supply is very, very constrained. Interest rates have made supply worse, and I believe that will continue to be so for the next few years. If you find this analysis useful, if there's something here that you'd like to share with someone, I'd encourage you to hit share, hit subscribe. Let me know what you think, and until next week, happy investing.